You were with us 3 weeks ago, the day before the FOMC meeting, and you said you thought that the Fed should take a pause then, and that they might very well do that. When you read the minutes today, what does it tell you about what they were thinking now and where they're leaning at this point?
I mean, it feels to me that they're moving toward a pause. It doesn't surprise me that they're having a debate, though, because despite all these rate increases, the economy is holding up pretty well. And I think that's a bit of a surprise. Part of the reason it's been holding up, though, I believe, is you've still got the remnants of fiscal programs and current programs, infrastructure bill, Inflation Reduction Act, the remnants of the American Rescue Plan that still hasn't been spent on a local level. And I think that's working at, to some extent, cross purposes with the Fed funds increases. So this is why the Fed is trying to decide what to do. The data is still stronger than they would have expected. But I think part of the reason why is what's happening on the fiscal side of the house.
So data dependent, though, at this point, that's, we've got the meeting 3 weeks from now. So are they more data dependent than they were in the past? Were you guys always watching the data so closely? Is it more driven now by that, looking at by number? 3 more numbers are going to determine the next hike potentially, or pause, and not so much forward guidance?
So in periods where the economy's at a point of inflection, I've always been strongly of the view that data should just be a part of the equation. You have to look at fundamental drivers, what's going on the ground, and what's likely to happen over the next year or two. I think it's dangerous to be too data dependent because data is backward looking by definition. And so if I were in the seat right now, I'd look at the data, but I'd also be aware of what's happening with fiscal policy and that it's blunting to some extent the Fed funds rate. The other thing I'd be looking at very strongly is the curve is historically inverted, okay? And that means I think further rate increases from here are a bit pushing on a string. They don't in any way negatively impact the ability of big companies to finance, because big companies finance based on the Treasury curve, and the Treasury curve is downwardly sloping. Pfizer just did a $31 billion debt deal below the Fed funds rate. Fed funds increases at this point disproportionately hurt small and mid-sized businesses and small and mid-sized banks. And that would be another factor for me to say, I think the marginal return of additional rate increases is diminishing here. And I'd rather pause. And I like the idea of a hawkish pause, meaning we're in a tightening stance, but we're going to adjust the data and turn over a few more cards before we take action. That's what I'd be doing.